The Bank of Canada, breaking news, has maintained its benchmark overnight rate at 1.75%. So holding the rate as expected at the current level, 1.75%. As I mentioned, it's the 9th straight meeting where rates have been left unchanged. The Bank of Canada saying that it sees signs of global growth stabilizing despite the continued trade uncertainty, and it's speaking about the resilience of the Canadian economy. The Bank of Canada retaining key forward-looking language, judging it appropriate to maintain the current level of the overnight rate. They say future decisions are going to be guided by its assessment of impacts from trade conflicts against what's happening with the domestic economy. I mean, look, let's face it, there have been some pretty encouraging signs about the Canadian economy so far in 2019. Jobs would be a great example of that. They also say that fiscal policy developments will also figure into the bank's updated outlook in January. And let's not forget, we just got through another federal election, and obviously we've got a Liberal government that is focused on a lot of spending to help the economy going forward. On the global front, the Bank of Canada saying October projections for global growth appear to be, quote, intact, with nascent evidence of stabilizing global economy. They do see global growth edging higher over the next couple of years, but they are speaking to those ongoing trade conflicts. And I would mention, as we take a look at the Canadian dollar, which right now is a little bit stronger than where it was against the U.S. dollar right before this decision. They've talked about commodity prices remaining relatively stable amid the uncertainty. And with the domestic economy, I mean, they're talking about that resilience. They say the recent 2% core inflation is consistent with an economy that is operating near capacity. They do see a pickup in inflation in the coming months due to temporary factors, but it's expected to track close to 2% over the next 2 years. Now, there's a lot more to get through here, but I'm joined on set by Karl Schamotta, Chief Market Strategist at Cambridge Global Payments. And you heard what we've said. You're looking through some of this. I guess the key issue is what they're saying about the outlook. What's your reaction to the Bank of Canada's commentary here?
Right. So, it sounds like they're really in that wait-and-see mode. They're not passing judgment on what they're seeing, but they are suggesting that loosening in financial conditions that has been engineered by central banks elsewhere in the world is helping to feed back into business conditions and helping to lift prospects for the Canadian economy. One interesting thing that they mention here is that they are continuing to monitor household vulnerabilities, suggesting that they are worried about the level of leverage in Canadian households and what impact that might have on consumer spending next year. One thing that they also mentioned that I think is a positive is that they're talking about investment, business investment in specific, saying that business investment has rebounded more strongly than they had projected. And that really sort of underlines that idea that perhaps we are going to sort of dodge a bullet and see growth return to the Canadian economy next year.
I'm glad you brought that up. Obviously, as we took a look at the third quarter GDP report recently, that was generally speaking, it's not a runaway growth story,
right.
But the fact that there was some business investment standing out, clearly the Bank of Canada is looking to that right now.
Right.
And to your earlier point about debt loads of Canadians, I mean, we've been talking about that story for years now.
Yep.
But the key is the Bank of Canada not participating in this rate cutting cycle this year, in part because of their own concerns about easy monetary policy and what that does to things like household debt.
That's it, exactly. I mean, the bank is really caught between the devil and the deep blue sea in a way. They're really caught in this scenario where if they do lower rates further, they're going to see an increase in those vulnerabilities in the long run. The last thing that they want to do is to push Canadian households into another unsustainable burst of consumer spending that eventually falls apart. And the reality here is that the horse is sort of out of the barn on that point. The reality is that Canadian consumers have spent too much for a very, very long period of time.
Yeah.
That is why debt loads are the highest in the G7, and we've seen one of the most rapid run-ups in the world.
Yeah.
But back to that business investment story as well, the fact is that in the last quarter, we saw an 8.5% increase. The quarter before was 7% decrease. So, that rebound suggests that businesses are becoming more confident about the future, although they're still saying in surveys that they're very uncertain about what the impact of all this trade uncertainty will have on business conditions.
If you're just joining us, some breaking news. The Bank of Canada holding rates steady, leaving its benchmark overnight rate at 1.75%. It's the 9th straight meeting where rates have been left unchanged. In reaction, we are seeing the Canadian dollar higher against the U.S. dollar, in part because of the commentary around the no change, the evidence the Bank of Canada is seeing that the global economy is stabilizing and describing a domestic economy that remains resilient, even with some of those worries on things like debt loads in this country. Karl Schamotta, Chief Market Strategist at Cambridge Global Payments, sitting with us. So let's dig deeper into this trade story. I mean,
sure.
Every day we sit here, we're talking about, is there a U.S.-China trade deal? Is there not? And a lot of people have been wondering what that's going to mean for the Bank of Canada in 2020. There seem to be a growing number of people that think ultimately the Bank of Canada is going to have to lower rates going into the new year, but certainly not setting that tone this morning.
No, and I think that most market participants, well, I shouldn't say most, but about 50% of market participants currently believe that we will see a cut by September of 2020. So that's really a first half cut. That is predicated on the idea that this slowdown we've seen globally over the last year will eventually translate into a slowdown in the Canadian economy. But we do have to always look at the counterfactual, and that certainly is what the bank is looking at here today. That is, what if the U.S. and China do come to some sort of agreement? What if that level of uncertainty falls, and at the same time we have this enormous pool of liquidity that's been provided by central banks sitting on the sidelines and pooling into the market or flowing into the market? If that's the case, we could be looking at a scenario that looks directly reminiscent of what we saw back in the late 90s under Greenspan. At the time, we had a high level of uncertainty afflicting the business world, and we had central banks step in to provide liquidity. What that eventually translated into was a massive rally in market prices. So, the challenge for the Bank of Canada at this point is to balance those competing narratives here. And the other thing to think about is this trade story really what it's cracked up to be? We hear sort of that cliched message every day, right? That cliched message is we have uncertainty. This uncertainty is weighing on business investment. We're seeing all these negative effects of this trade war. But when you really look at the numbers, the reality is that the American consumer continues to spend ad infinitum almost. There is no sign of a slowdown in U.S. consumer spending here.
Yeah.
And that is the engine for consumption globally. So is all this trade uncertainty really affecting the world as much as we think it is? Perhaps not just yet.
Just so amazing in a week. I mean, when we literally heard the president yesterday talking in a way that suggested maybe there's no trade deal for more than a year.
Right.
And then the reporting this morning is that no, actually both sides are much closer. This is hard stuff to figure out. But to your earlier point, business investment was actually picking up in the Canadian economy in third quarter. So maybe chief executives are kind of moving beyond some of the rhetoric, however you want to describe it.
Yeah, I mean, if you have the U.S. government running a fiscally expansive policy framework, if you have central banks providing liquidity, and you have financial deregulation all happening at the same time, all of those are ingredients for a U.S. consumption rebound, and that's what we've been seeing. So the thing is that any business who is looking through that narrative, looking through what they're seeing in newspapers and looking at the numbers, they're likely to conclude that they should be investing more.
If you're just joining us, the Bank of Canada has left its benchmark overnight rate at 1.75%. So no change. That's what market participants were expecting. We've seen the Canadian dollar rallying against the U.S. dollar on the heels of that news, in part because the Bank of Canada talking about a global economic picture that looks relatively healthy, and more specifically talking about the resiliency of the Canadian economy. We're joined in studio by Karl Schamotta, the Chief Market Strategist at Cambridge Global Payments. And he talked about the fiscal picture in the United States. Let's talk about the fiscal picture in this country, because the Bank of Canada is setting the stage for what they might be talking about in January when they give a bigger economic outlook. And they are looking at the fiscal side of things. We just got through a federal election where once again the Liberals were voted in, which means there's this spend to help the economy long-term plan. Is there a way to quantify what some of that fiscal spending could mean for the Canadian economy?
I think what we've looked at is a 1.3% expansion in fiscal spending next year, which is positive for the economy and certainly will lead to some sort of front running in markets as markets get ahead of that spending. So what the bank is looking at here is as opposed to drag on the domestic economy, something that's positive and helps to offset weakness in other areas. Now, the question, of course, always has to be how much of that actually does happen. It's been very difficult to draw a straight line between the platform or the promises made on the election campaign level through to what happens in the economy over the last couple of years. If you remember 4 years ago, we were talking about infrastructure spending exploding, and that just did not occur.
Did not happen, yeah.
So, I'm not sure that we can rely on it, but it is likely to be a positive that helps to offset some of that uncertainty elsewhere.
Carl, before we wrap up, currencies are your specialty. Now, before this decision, I mean, we're getting to the end of the year, a lot of people making outlooks. I'd seen some pretty high-profile ones, JP Morgan, which has been calling for a weaker loonie heading into the new year. And I think that's in part because of this belief that maybe the Bank of Canada is going to have to lower rates.
Right.
But we've seen a nice rally in reaction here today. What's your outlook for the dollar?
Well, it's complex. So in the near term, we do think that there is a possibility that we see the Canadian dollar rise. And this is on the basis of all that liquidity being provided to financial markets at year end. So what's happening this year is very, very important, I think, for most market participants. What the Fed is trying to do is avoid the repo collapse that happened at the end of last year. They're providing liquidity to the financial markets. That's going to, reduce some of that risk. At the same time, you have stimulus coming from every other, sector of the economy to some extent. And so that could lift commodities, that could lift the Canadian dollar. However, longer run, those household vulnerabilities that we've been talking so much about, those are going to eventually exert drag on the Canadian economy and start to compress consumer spending. When we start to see consumer spending fall off, we're likely to see the Canadian dollar fall off. And so our forecast is that we see Canadian dollar rise slightly into the end of the year and then fall off through early next year.
Well, it'll be fascinating to watch because I know we're a nation of debt lovers, but at the same time, we've been doing plenty of holiday shopping so far. So who knows? Carl, thanks as always. Appreciate you breaking it down for us. Again, the Bank of Canada leaving its benchmark overnight rate unchanged. That was Karl Schamotta, Chief Market Strategist at Cambridge Global Payments.